Good evening, and thank you for allowing me the opportunity to talk with you this evening. As was introduced, I am the Chief Executive Officer of Macquarie Infrastructure Company, and whilst it may be somewhat lost in translation to some of you, I live in New York, I run a New York Stock Exchange listed company, but I am an Australian by birth. So I feel both free to look at the US from an objective perspective, free to be somewhat terrified about the outlook that unfolds with the amount of uncertainty, but also deeply invested in the success of the United States as someone who runs a $7 billion US company, and more importantly, someone who has two sons who are US citizens, having been born in the United States. So keep in mind as I speak about my company and our investment prospects in the United States that I am both a resident of the United States but also an outsider living within the United States, not having been born or grown up there. MIC is a company, a publicly listed company, and subject to US securities law. So to the extent that you're interested in an opportunity in our company or investing in our company, I would advise you, as is always the case, to do your own independent research and examine that information available to you. MIC IPO'd on the New York Stock Exchange in December of 2004. We have been in existence for over 12 years, just past 12 years. And during that time, we have given our shareholders total shareholder returns of 16.1% per year. We currently trade on a 6% or 6.3% dividend yield, and we have indicated to our shareholders that we will continue to grow our free cash flow per share by 10 to 15%. If you go to the lower end of that range of 10% growth and 6.3% dividend yield, you get to a 16.3% total return going forward, which is very similar to the 16.1% we have achieved since our IPO in 2004. And so what we represent as a company is the opportunity for current income and current yield with growth. The way we achieve that is by investing in businesses that we think have strong, stable cash generation. The businesses that we own, that I'll take you through in a second, are very unsexy businesses. They are not flash, there's not technology, there is not high levels of R&D. They are essential parts of the US economy with high physical assets. They have preferred market positions and very high barriers to entry. They typically have an inflation protection within them in the form of an inflation or CPI index in the revenue contracts that see our contracted revenue grow as inflation grows. And our debt, which we have, is all fixed rate debt and has an average maturity left to run of 7 years. So to the extent that the cost of borrowing goes up, we are insulated against that for the next 7 years. If I go to the next slide, we talk about the fact that we own a business that delivers 6.3% yield, but importantly to value and value creation from our perspective is growth in that free cash flow. Because growth in the free cash flow is what allows us to not just continue that dividend, but grow that dividend. And we lay out what the drivers of that growth will be. The existing assets, the infrastructure businesses we own in the US, will grow organically at 3 to 5% per year. That will be in part through GDP growth and in part through inflation-linked revenue growth. The operating cost controls that we will put in place will further deliver 2 to 3% free cash flow per share growth. So those first two lines are essentially what we get from our existing assets today. And if you add them together, you get 5 to 8% free cash flow growth from what we own today. And then we intend to spend, as we have spent historically, on building more infrastructure in the United States. And from that growth, So long as we do that growth and invest and execute those growth projects on budget and to historical rates of return, we'll get another 4 to 6% growth in our free cash flow per share. And that requires us to spend essentially $350 million a year on growth CapEx projects. And if we do that and we optimize our capital structure, as well as the current income we generate, we'll generate growth in free cash flow, which will allow us to grow our dividend. And if you look back, so that's our promise going forward. But if you look back historically, our promise going forward is really very little than a statement that we will do in the future what we have really done over the last 10 years. We pay out to our shareholders 75 to 85% of our free cash flow in dividend. The amount that we don't pay out in dividend, we retain to fund growth projects within the company. As I said, our targeted dividend payout range that we've guided people to is 75 to 85%. Over the past 12 months, we've paid out 77%. So we're at the low end of that payout ratio. One of the reasons we're at the low end of that payout ratio is there are more growth projects available to us and more attractive growth projects available to us that we are investing in. We've grown our dividends since 2013, if you go back the past 4 years, by 12.7% per annum. That's right in the midpoint of that 10 to 15% guidance range that we've provided. And we're continuing to target a range of 12 to 14% through 2016, and we've already achieved that with 1 quarter left to go in 2016. And so what you see, as you would expect from stable, unsexy infrastructure assets, is a fairly boring but slow gradual growth in dividend that you see there. We think that the more boring and stable our businesses are, the better the financial return to our shareholders. So what are the businesses that we own in our portfolio? We own 4 businesses. We have a diversified range of businesses, and we intentionally have a diversified range of infrastructure businesses in the US. The first business that we own is a bulk liquid storage terminal business. It stores chemical products, it stores petroleum products, and it stores vegetable and animal oil products. Some of those products are imported into the US and some of them are exported from the US. And that business represents roughly 47% of our EBITDA, or our earnings. The next business we own is Atlantic Aviation, where we operate at 69 airports across the US, and this business is around 32% of our business. We provide infrastructure, terminals, and refueling capability to general aviation in the United States. The third business we own is a contracted power business that typically has long-dated power offtake agreements that provides power in the different states to different states of the United States, and that represents 15% of our business. And our final business is a business in Hawaii, which again is a conglomerate of businesses, and I'll get to that in a second, that represents roughly 10% of our business. Each of those companies has its own management team. We oversee the performance of the management team at those companies. We arrange the balance sheet and the debt financing for that management team. We do the taxes, and we set the corporate strategy for each of those businesses, and then the local management team executes against that strategic plan. The largest business, as I mentioned, is a bulk liquid storage terminal business, International Matex Tank Terminals, or IMTT. It's one of the largest providers of independent bulk liquid storage terminaling in the US, and within that, again, we have diversification. We have 12 separate geographic locations, 12 separate terminals that we operate. There are the 3 product categories within those terminals, whether it's petroleum products, and that's predominantly refined petroleum products, chemicals, or agricultural products. 81.5% of the revenue we get is on long-term contracts with customers. And those long-term contracts have inflation escalators within them. To that extent, we would actually like to see a little bit more inflation in the United States, as it would see the revenue line grow a little faster with these businesses. We keep our tanks full. The average contract duration has roughly 4 to 4.5 years on it, and when it comes up to renewal, we renew those contracts, which is why you see those utilization rates on the line relatively high in the mid to high 90% range. So we run a business that imports and exports liquid hydrocarbons in the US. We don't own any of the products that are stored in our tanks. We simply rent space to the petroleum, chemical, and agricultural companies that do. If the commodity price fluctuates, that's a risk that they bear. It's not a risk that we bear. We first bought into this business in 2006. And when we bought it in 2006, we bought 50% of it, and it did $67 million in annual earnings. This year, it will do in excess of $305 million in annual earnings. So we've grown the earnings over the last 10 years. The way we've done that is deploying $1 billion in growth CapEx projects. $100 million a year over 10 years, $1 billion. $950 million of that has been on building new storage capacity on the existing land that we own, and $50 million has been on acquisitions. So $950 million is on building new infrastructure, and $50 million is on buying an additional terminal. To give you a visual impact of what our facilities look like, you see the two largest terminals we have here. The Louisiana IMTT St. Rose facility, the green facility, is located in just out of New Orleans. It has 16 million barrels of storage. The facility on the right is our New York Harbor facility. The New York Harbor facility, you can just see the Manhattan backdrop in the distance, and you can just make out the Statue of Liberty. We own 600 acres of land immediately proximate to New York, and 50% of the gasoline consumed in New York market flows through our terminal. To put it into context, the Department of Homeland Security in the United States has classified 12 locations in the United States as mission-critical energy infrastructure in the United States, and our facility in New York Harbor is one of those 12 destinations in the United States that's located mission-critical infrastructure. People store their product with us because they have waterborne access through large vessels to load or offload. There is pipeline connectivity to the Colonial Pipeline and other pipelines across the US. There's rail access and there's truck access. There's also, immediately adjacent to this, one of the largest energy consuming markets in the world, the New York, New England energy market. And that, for us, is a business, it's a thing of beauty. For most people, they look at those white bulk liquid storage tanks when they fly into them and see an eyesore or part of the industrial landscape. For us, we see a mission-critical part of the US energy supply chain and something that delivers us $305 million in profit this year and used to deliver us $65 million in profit. It's the sort of infrastructure business that we like. In one sense, when people fill up their car with gasoline, no one cares where it came from or how it got to the gas station. We are the part that no one cares about, and we make substantial returns from it. The second business that we own is Atlantic Aviation. We operate at 69 airports across the United States. At those airports, we own fuel terminals, we own hangars, and we own airport terminals. We lease that space from the airport authorities. There are no privately owned airports in the United States. None have yet been privatized. We're hoping that some will be privatized, but none have been privatized today. The weighted average lease life that we have at those airports is around 19.5 years. 10 years ago, in 2006, the weighted average lease life was around 18 years. So notwithstanding the passage of a decade, we've been able to push back those lease lives. And those leases for us are the right to bill people for the services that we provide. The more flight activity there is in the US, the more revenue we can generate from servicing that flight activity. If you look at the locations in question here, this is an example of two of the facilities we have. One is at Las Vegas Airport, where we service the private aviation and private jets that you see there, and the other is at LAX, Los Angeles International Airport. To put the size of the private jet fleet in the United States into some context for you, there are around 24,000 private aircraft in the world. 19,000 of those 24,000 private aircraft are based in the United States. It is a massive market, but one that outside of the United States, few people understand because there is just not the same level of private flight activity outside. Again, this business, which does around $220 million in profit a year, we own 69 locations. When we IPO'd in 2004, we owned 14 locations. So we've grown it substantially by investing in more locations. The third business we own is a power business, a contracted power business. We own a 512 megawatt gas plant in New Jersey, which is the green dot. That has 8 turbines, 8 units of generating capacity. 5 of those units are contracted and 3 of them are merchant. We own solar facilities across the southwest of the United States and wind facilities in Idaho and New Mexico. In aggregate, we own about 1 gigawatt of power generation. All of the renewables power is contracted for in excess of 15 years with investment-grade utilities. There are CPI escalators in those contracts. We like this business because it's contracted and it has a good contracted profile. However, it doesn't organically grow unless you add new locations. There's no inherent growth other than the CPI escalation. So it's a business that we really, really like because of its predictable cash flow nature. If you look on the next slide, you will see that where we own the gas plant at the Bayonne Energy Center, that is immediately next door to our bulk liquid storage facility. And again, in terms of mission critical infrastructure in the US, this electricity that's produced here in New Jersey, just next door to New York City, travels through a 6-mile under harbor transmission cable that we own and provides electricity to downtown Manhattan. We have a very stable source of energy consumption in that our prediction is that Manhattan electricity consumption will only continue to increase. And the solar facilities that we have a guaranteed offtake with the utilities that they serve. The fourth business, in many ways the smallest but my favorite, is our Hawaiian business. We bought that business in 2006, and it is a gas distribution business in Hawaii. It was doing $25 million in earnings when we bought it 10 years ago, and we've grown that $25 million to $60 million in a decade's time. As well as now distributing gas, we also do solar generation on the island of Oahu, and we've bought a mechanical contracting design build engineering firm to help us build more infrastructure in Hawaii. So with each of these 4 businesses, and the next page just shows some generic photos of Hawaii, of the infrastructure we own there. One of the reasons we've put the boring infrastructure in, the picture of the solar rather than an attractive photo of Hawaii, is we like to show investors the difficult parts of Hawaii rather than have them think that when we travel to Hawaii for business, it's all beach and sunshine. If you look at all of our businesses, we bought a business and we deploy capital to grow that business, whether it's growing aviation and airport infrastructure, growing fuel distribution infrastructure, or power generating infrastructure. We use our balance sheet, which has a lot of capacity available, to fund that growth, and the more we fund that growth, the larger our business becomes and the larger our dividend becomes. We've averaged $250 million a year in growth capex in the decade since we've IPO'd, and we've recently increased our guidance to take that to $350 million, given that we're now a larger company. Where we stand is a company that's delivered, we think, good shareholder growth for people through investing in mission-critical infrastructure in the US. The part that's exciting for us as we go forward is we see an incoming president who is focused on ideally enhancing US infrastructure, but using private sector financing to do so. If you're going to invest in infrastructure, there's probably three capabilities that you need. You need financial capability for structuring the acquisition, the debt structure, the tax structure, to make the financial engineering of the business work. You need operating expertise. You need literal engineering expertise to run the businesses and grow the businesses. And the third capability you need is the ability to work with regulators, to have regulators trust you, whether it's airport owners, the FAA in terms of our airport infrastructure, the Hawaiian government in terms of the energy infrastructure we run there, or the Department of Homeland Security and the Environment, the EPA, for the bulk liquid storage terminals you run. The reason we're excited about the outlook for our business is we have those three capabilities. We have the financial engineering capability, we have the physical operating engineering capability, and we have the experience with regulators. That will all allow us, as assets become available to build or buy in the US as part of the infrastructure revitalization program, to invest prudently in the best opportunities that we see available there, and hopefully grow our business at more than $350 million a year in growth capex. That will allow us to grow that dividend still faster. In the time that's left, I'm happy to take any questions you may have over infrastructure investing in the United States or our business and the opportunity specifically. Thank you.